Good afternoon and welcome to the first LGT Vestra Investment Landscape webinar of 2021, entitled Hope for the Future. I'm joined today by Jonathan Marriott, our Chief Investment Officer, Russell Harrop, our Head of International Equities, and Jeremy Sterngold, our Head of Fixed Income, for what we hope will be an informative and interesting session. We're going to start with an update from Jonathan, looking back on the last quarter and also on the outlook for markets from here on, followed by a live question and answer session with our asset class specialists, where guests will have the opportunity to ask questions via the Zoom chat function. Whilst the last year or so has been a particularly challenging period for investors, we feel that the final quarter of 2020 has provided us with reason to feel hopeful about the future. And with that in mind, I'll hand over to Jonathan for an update.
Okay, thank you, John, for the introduction. We can't ignore the pandemic. With 2 million people dead, it's been a tragedy on both personal and economic level, and it's been hard for many families to survive. But if one said there'd been a pandemic, there was going to be a pandemic on this scale, and tell you that the US market would be hitting all-time highs at the end of the year, I wouldn't have believed you at the start of last year, and yet that is exactly what happened. Q4 was generally positive for most equity markets. And what's happened in the last year really has been a balancing act. It's a balancing act between the pandemic and the new variants of the pandemic against the vaccines and improved treatment. The economic damage done by the restrictions around the pandemic, restrictions on movement that we're all suffering from at the moment, is balanced by the fiscal and monetary stimulus that has been absolutely colossal over the last year. So what happened in the last quarter to tip things in favor of equity markets once more? Well, in the last quarter, clearly we saw progress on vaccines. The UK has been leading the way on this. In fact, the UK has been leading the way on the analysis of the virus, and that's perhaps why we've detected the new variant here, where there are new variants happening all over the globe. And now we've got a more infectious one in Brazil being detected, and in South Africa. But clearly this is not something that's going to disappear. But at the moment, the vaccines appear to work for the new variants, or said to work for the new variants. And so that is unadulteratedly good news for an economic recovery from the disaster that was last year. Secondly, in the last quarter, we saw the Biden election, with the prospect of greater stimulus outweighing the prospect of higher prospective taxes. That was viewed as overall positive for the market. From a personal point of view, I'll be very glad not to have to be watching Trump's Twitter feed continuously to see what's happening in markets. In Europe, we finally saw a budget agreement, which included 750 billion of additional pandemic recovery package, which will be broadly supportive for markets. And finally, in the UK, and perhaps from an international point, the least important, was the Brexit deal, which got done at the last minute, basically after most people had gone home on Christmas Eve. Firstly, returning to the pandemic, new, more virulent strains are appearing, but the vaccine is countering that. The UK is leading the way. The US is now getting much more serious about the vaccine. I've lost count of the number of executive orders signed by Joe Biden in his first less than a week now in office, but a lot of them have been directed at vaccine distribution, the wearing of masks, preventive measures, restrictions on travel, all things that we've got used to over here, but perhaps hadn't been done certainly on a federal basis in the US. In Europe, the vaccine rollout is going out somewhat slower. They seem to be lashing out at AstraZeneca, who they haven't actually approved yet for reducing the amount of doses they're going to supply. But really, it's layers of bureaucracy that seem to be getting in the way. France is particularly slow in doing it, but this will come through, and there is light at the end of the pandemic tunnel. Biden's election came as no real surprise. He'd been leading in the polls. The one person who seemed to be surprised by it was Donald Trump, who cried foul. But what did perhaps surprise people is that he managed to win the Democrats managed to win the 2 seats in Georgia in the Senate, which gives them a 50-50 split in the Senate. This means that they have a majority of 1 when they use the vice presidential vote to break the split. However, there are rules on being able to talk things out. The filibuster mean that you can only overturn that with 60-40 split in the Senate, and so unless they use something called a reconciliation bill, which can only be used for payments, they need to seek cross-party approval in the Senate to really get things going. In that respect, we've already seen the 1.9 trillion proposed package disputed by the Republicans, but Biden has already indicated that he's prepared to compromise on that. And after 36 years working in the Senate, he knows Mitch McConnell well, and he has stressed that he wants to take a bipartisan approach and seek unity. I think unity was the word that was mentioned more often in his inaugural speech than anything else, in his attempt to pull the country together after its much divided period under the Trump administration. A tall order, given some of the more extreme views that are being taken by QAnon and the like. He will also seek some cooperation on a multilateral basis internationally. It's pleasing to see that they're rejoining the World Health Organization. Again, another move to combat the pandemic globally. They're rejoining the Paris Accord on climate change. And there, as we see further packages of stimulus come through, we may see more spending, certainly expected to see more spending on infrastructure, particularly green infrastructure and projects around climate change. They've already halted the Keystone XL pipeline, which was ecologically, shall we say, unsound, but would have increased the supply of oil. And as far as China's concerned, he hasn't rolled back Trump's tariffs, but we can see that there's going to be a more multilateral approach, and he'll work with their allies, particularly in Europe, to counter the Chinese unfair trade policies, as they would see it. And we can expect perhaps a more gentle approach there, which certainly will be welcomed by markets rather than the rather abrasive view taken under the previous administration. Finally, coming around to Brexit, there was a deal done, but we have to temper it with the fact that the red tape is it means that much trade is not going quite as smoothly as we would like. And the main sticking point is really financial services were not included in the deal. These are dependent on the equivalence rule in Europe. They talk about negotiating equivalence. In practice, it's in the grant of the European Union. And the European Union has been, certainly the ECB today, officials are talking about getting more jobs switched across to Europe. The one unfortunate side effect of this is also that the Scots nationalists are calling for another referendum, and there are threats to the union. Whereas one might have expected international investors to return to the UK and the pound, they may be put off by the thought of breaking up the union, although that's probably less relevant to the many international stocks that are listed in the UK. Over the last year, we've seen enormous dispersion of returns, and this continued in the last quarter. Just to give you an idea of the dispersion on a country basis, the FTSE 100 index on a total return was down 12% last year. The S&P 500 hit a new high and was up 18%. Within that, you get different sectors, and certainly technology, which has benefited perhaps from work from home and from growth in that sector. The NASDAQ, which is technology heavy, was up 45% last year. And yet even within the tech sector, you get dispersion at a company level. Within the tech sector, you've got Microsoft that certainly benefited from the work from home, up 30%, whereas Amadeus, which provides the booking systems for airlines, was hit badly by the unexpected travel ban and was down nearly 30%. So huge dispersion at a company level, country level, and sector level means that there are huge opportunities for active managers. The final quarter, there was a lot of talk about value versus growth. I think this is a little bit misleading in that what actually rallied in the last quarter were things that were hit hardest in the pandemic, and those that came closest perhaps to being bankrupted by the pandemic and going out of business. Highly risky situations, highly leveraged companies have bounced back perhaps more than the core growth portfolio stocks that we prefer on a longer term basis. But they are hampered in terms of leverage and gearing as we go forward. The pandemic has accelerated trends that we think will not necessarily reverse overnight. The move to online shopping, certainly when the high street reopens, some shops will go, there will be some shopping going back to the high street, but the high street has been permanently damaged. It's interesting to see over the weekend that we saw ASOS and Boohoo bidding for Debenhams and Topshop, but not the shops, but for the names that they can use them online. Those names will disappear from the high street, and the high street will need to be repurposed. Work from home is certainly a trend that's continued, and I think that people have realized that they can get away with fewer face-to-face meetings. And certainly while business travel will resume, I believe that there will be nowhere near the amount of business travel, which may hamper the recovery of the airlines that depend on that. So that's the high-end airlines rather than the low ends, which may get a lift from the return to holiday travel. So we expect dispersion to return, and leverage has increased both on a personal, company and a sovereign basis across the board as a result of the pandemic. This means that raising interest rates will be very difficult. Now, normally you'd expect interest rates to rise in response to inflation. And certainly we may see a slight pickup in annualized inflation because of the base effects of where things were last year and because people returned to shopping. But the disinflationary things are still around longer term. The threat of tax rise is another thought that probably keeps interest rates low, in that governments may look to fill the funding gap they've got through raising taxes. I would caution against this at any time soon, and certainly Janet Yellen said their focus was entirely in supporting the pandemic, and tax rises would wait until a later date. And I think that may be a wise course of action. So where now for equity markets? People talk about things being expensive, but when one looks against the level of interest rates, in the US, 10 years at 1%, in the UK and Europe, Europe negative, UK only just positive. Interest rates may rise a little bit, but against the earnings yield, dividend yield, equity markets broadly remain attractive. But while there may be some bounce back in things that have got beaten up and have got high leverage, in the long run, that's going to make difficulty to grow your earnings. And we believe that the quality of balance sheet and growing earnings will remain key to the returns. And therefore, we favour a more concentrated equity portfolio or managers that take that approach and looking to compound returns over the long term. In Asia, they've come through the pandemic better than most. And so we continue to favour Asia, although again, that's a slightly patchy picture. I was speaking to somebody in Malaysia yesterday who said they're not getting any vaccines till March because of political differences that are going on there. It is a patchy picture where Singapore's come through it relatively well. China is going to be the largest economy once again in the world within 10 years. And we think that is a huge growth opportunity still for many investors. And otherwise, in geographical areas, we still favour the US, where we see the most attractive long-term growth in companies, despite what the rising death toll there and the infrastructure spend that's going to come through there, and the growth in the recovering economy, we believe, will favour that area. The UK we're slightly more neutral on, given the sort of two-sided face of Brexit still weighing on the markets, and it's also a more service-based economy, which has been where the pandemic has weighed hardest on things. But overall, we favour a selective approach to equities. On bonds, there's a place for for some bonds it remains some place for bonds in portfolio with interest rates remaining low for a long time, particularly US treasuries, which continue to provide a good hedge against everything else going wrong, say the vaccines didn't work on a new variation or something like that. But overall, a positive picture for equities going forward. And on that note, I'll hand back to John for some questions that may have come through as we talked.
Thank you very much, Jonathan. So yeah, in the next part of this webinar, we're going to move on to a question and answer session. We'll start with a few questions that we received ahead of today's event. So thank you for those who sent those in advance. And if anybody would like to raise any questions throughout this session, please could they submit these via the Zoom chat function, and I'll try to go through these and direct them to the relevant person on the team. We'll try to get through as many of these as possible, but for anybody who has any answered questions after the event, please do feel free to raise these with your LGT Vestra contact, and we'll aim to get a response back to you as soon as possible. Great, thank you. So if I start off with a question that has been raised for Jeremy on fixed income and inflation. So yeah, Jonathan, you touched on interest rates in general, and I think obviously interest rates or the direction of interest rates will to a degree depend on where inflation is headed. So Jeremy, do you think there's an increasing risk of higher inflation given the amount of stimulus that we have seen throughout the pandemic?
Thanks, John. So in terms of inflation, I think we need to look at two distinct periods. The first is the current, looking ahead short term, where there are signs building that we will see inflation picking up above central bank targets, which would mean over the next year we'll start seeing prints close to 3% annualized inflation, somewhat in the UK, US. And there's a multitude of factors. Some is the base effects, such as Jonathan mentioned, which means that last year oil prices were a lot lower, closer to $30. We now have oil prices closer to 50. So the change in that and sort of where you measure it from mean we'll see higher inflation. There's also some pent-up demand brewing in the economy. That might be in the manufacturing side where we see some supply shortages, and would also be for consumers where we've seen the savings rate tick up. And so if we do get a successful rollout of vaccines, we can expect travel and leisure seeing a lot of demand, and prices could increase quite substantially there. Now, that's the short to medium term effect, because as we know, being in lockdown, there's activities we all wanted to do, maybe see some more friends in restaurants, and probably there'll be a bit of catch up until we have a more normal way of life, or one that looked a bit closer to what we were used to pre-pandemic. Moving ahead of that, despite the record amount of monetary easing and some fiscal programs, what we do see is there will be some what we call slack in markets, which would mean companies not operating at 100%. The unemployment rate is likely to be higher for the next few years, and level of demand might not be there at the same level it was pre-pandemic once these pent-up savings has been used. Combined with the demographic trend in the world and the level of debt, the more indebted we are, the less likelihood we have discretionary spending following that, means that over the medium term, we're less convinced that inflation will really be a problem. That's just kind of a factor of where we are.
Great, thank you, Jeremy. I think we might come back in a moment for a bit further on that in terms of sort of implications for interest rates. But in the interest of sort of sharing the questions around, Russell, one's coming for you, sort of on the equity side. So, and it's probably in relation to the technology sector. So, given how well the NASDAQ and the tech sector has done so far, and particularly in the last sort of year or so, do we think these US mega cap technology companies can keep going?
Okay, thanks, John. I mean, it sounds like a statement of the bleeding obvious to say 2020 was not a typical year. but I mean, it was very atypical. We haven't had any pandemics for a very long time. I mean, if you watch the film, the Contagion film from 2011, which looks like a documentary now, you will see that the pandemics have been predicted for a long time. So they've been predictable, but not predicted for 2020. But as Jonathan alluded to, no one really would have expected when we were back in February, March, going into massive lockdowns pretty much everywhere, that you'd end up with the S&P up almost, I think 50%, S&P up 18% for the year in America. The NASDAQ tech heavy, as you said, John, up almost 45%. That's even after most of those fell a lot in March. So that is pretty unprecedented to see those returns in any normal year, let alone one like the decade-long year that we just had. But it's worth also thinking about what did change, what didn't change. Again, Jonathan really alluded to this earlier, but we don't think the whole world changed in 2020. We think really what happened is the trends of the last 5 years just accelerated. I mean, to take one example, if you look at online food shopping in the UK, Ocado, and you look at a chart of where the growth was, effectively 5 years of growth came in 3 months for the company. And you can see quite a lot of areas where that's the case, really. Online shopping is the classic one. We've all been talking about the death of the high street for quite some time, but you really saw the nails hammered into the coffin in 2020. And the question is, from here on in, without a Debenhams, without a House of Fraser, maybe without some John Lewis's, do shopping malls really have any relevance to most people? So yes, we think they can continue. The key thing is what the growth is going to be like. So some stocks have really run ahead of the growth, but equally, we're probably going to end 2020 with Amazon seeing 40% revenue growth. It's not a small company. It's not small in terms of revenues, but they'll probably have nearly saw a 50% increase in their sales this year. Zalando, which is like ASOS, but in German-speaking countries, that probably will end up with a 25% increase in revenue over the course of the year. So we think growth will continue for many of these names. Could you have a pause in some of the names whilst they catch up to their valuations? Yeah, that's perfectly possible. But ultimately, if companies do compound away, it's the compounding that drives the share price rather than the starting valuation. I mean, just to give you a really good example, if you take two companies, one which has a price earnings ratio of 40 times, one which has a price earnings ratio of 20 times, and if the more expensive stock grows at 15% and the cheaper stock grows at 5%, and you assume they trade on the same valuation in 10 years' time of 20 times, you'd have made a 25% higher return on the twice as expensive stock today. So it's really important to decide whether you think growth is sustainable going forwards. And that's why we focus on companies where we think the growth is sustainable, but equally, we don't assume that Amazon is going to go at 40% every year for the next 10 or 15 years. And the other thing just to be aware of is the other thing that really has happened, and this is a really good example, pre-pandemic, I don't think I was ever on a Zoom call that I can recall. Now we're on them all the time. And it's the new normal, isn't it? We've demonstrated that it's perfectly possible to do this. I mean, I think there are over 100 people on this call at the moment. So some things have really changed. Home working, mobile working, these sorts of things which benefit the likes of Microsoft and Adobe, their growth trends are probably much higher now than they would have been pre-pandemic.
Yeah, agreed. Thank you, Russell. And we can come back on valuations in a moment because we've got another question on that. If I move back to Jeremy again. So yeah, thanks for the sort of your views on inflation. Sort of, I guess, related to that in terms of sort of next directions for interest rates. There's been quite a bit of talk, and I know we've discussed it at our investment committee in sort of a number of times. Around the potential for the Bank of England adopting negative interest rates at some point. So yeah, how likely do you think this is?
Thanks, John. So we've debated this in quite depth over some time. The likelihood we still think is relatively small. The caveat to that is obviously how effective the vaccines are at combating the virus, and the likelihood of them being able to work for the new variants that we've seen come over the past few months. So it's the efficacy of the virus and how quickly economies can reopen. So I'd say what's been priced in generally in markets is we see a gradual opening up of the economy somewhere in the summer, and by next year, life looks a bit closer to where we were pre-pandemic. Why would the Bank of England consider negative interest rates? Well, at the moment, the tool of preference for the Bank of England is QE, or further purchases of gilts, and to a very much smaller extent, corporate bonds. And they prefer to use this tool because negative interest rates causes some issues potentially for the banking system. There recently was a report that the big banks, it will cost them in aggregate about £1 billion a year to operate negative interest rates, plus the IT issues and the fear, which we haven't seen so much given negative interest rates are widely adopted in the Eurozone, but still the fear that people take the money out of the banks and put them under their mattress. That was always a fear, and that's also part of the reason central banks came to being. They guarantee your currency, keep some safety, and keep the banking system flowing. So there is some fear that people will just take money out. Why would they do it? Well, I think a fact that's not necessarily as appreciated by markets is just the composition of the program. At the moment, the Bank of England has increased their purchase program in November by a further 150 billion, which is expected to be rolled out over the course of this year. That would take the total amount of gilt purchases to 875 billion pounds. What is interesting about that is they won't buy UK Treasury bills or government bonds maturing within the next 3 years. So that leaves them of a pool, and also, sorry, I forgot to mention, not inflation-linked bonds either. So the available amount of maturities meeting those criteria is 1.2 trillion pounds. If the deficit increases at a pretty high rate as it has this year, we look at the Bank of England probably owning somewhere between 65+% of the gilt market. Within their parameters of the program, they are looking to own a maximum of 70% per individual bond. So they're getting pretty close to the self-imposed limits of owning or cornering the markets. And if they feel a need to loosen conditions and they don't want to buy corporate bonds or be a bit more nimble to try and tackle other asset classes to buy, they would find themselves in a position where there's not many more bonds to buy and cause further issues. So to encourage people not to sit on their savings, as we've talked in the inflation piece about the savings rates being very high, they may seek to adopt something like negative interest rates. But from the commentary from Governor Bailey and some of the various members of the Monetary Policy Committee, they seem less keen to adopt negative interest rates, and would probably only result if we find ourselves in a very fearful scenario of the variants proving resistant to the vaccinations and they need to adopt further more aggressive tools.
Good, thank you, Jeremy. That's very helpful. So we had a question come in here, which I think is probably going to be one for Jonathan or Russell. I don't know who wants to take this, but the question is, does the opening of the travel industry not depend on a global vaccine rollout rather than the grab what you can approach currently taken by the richer nations at the expense of poorer nations?
Yeah, I think that's from an investment point of view, dare I say it, it sounds horrendous, but it's perhaps less relevant than you might think. But certainly, if one's purely looking at sort of travel industry from a tourism point of view, from a Northern European point of view, then the main countries that you go to for tourism, the bulk of it is Spain, Italy, France, Greece, the Southern European states. Who are all getting the vaccine from the EU. So in that sense, as far as third world travel is concerned, yes, delivery of vaccines will be important. There are moves being taken by the World Health Organization to ensure distribution. India is one of the biggest makers of vaccines in the world. So they've rolled out a huge vaccination program there. Other countries are being slower, and some of the poorer countries. But it sounds horrendous to suggest this from a travel point of view. There's some of the poorest countries in the world who aren't getting the vaccines are perhaps less popular destinations. China, for instance, there's vast internal tourism. Certainly, having visited the Great Wall of China a few years ago, the number of visitors, you think it's a world site to go and visit, but the majority of tourists visiting the Great Wall were actually domestic Chinese tourists who vastly outnumbered the foreigners. So there's a huge internal market for travel there. As I say, I think the problem comes in for the travel industry is the sort of high margin stuff maybe slower to get going than the lower margin low cost airlines and things like this, where there may be a bounce back in people traveling to within Europe, say. But there is certainly more of an ecological move, of course, to away from flights altogether. And from a business travel point of view, as we become more conscious of ESG factors, then business travel may decline. But certainly the rollout of vaccines across the world should be something that we should be proud to be supporting as a country.
Great.
Do you want to comment?
Can I just add something, John?
Yeah,
yes, of course. Yeah, please.
Yeah, I was going to say, I mean, Jonathan's point about where people travel, it's interesting how people are able to change their behavior, assuming you have a job and you can afford to go on holiday, which is not an assumption for an awful lot of people, sadly. But it was very, very noticeable in America, particularly in Airbnb's numbers. The Q3, they haven't released Q4. So Q3 is the quarter to September 2020, which was still a difficult quarter for the whole in America. They basically found loads of people who, looking at Airbnb's results, it's a global company. They found lots and lots of intra-country travel rather. So you could particularly see it in the States. You saw a big move from people going overseas on holiday to going within the States, but also you saw a big change in terms of people going for longer periods of time and working from where they were. So you have seen a bit of a change of behaviour in that respect. And you can certainly see it in the UK, whether anyone will be able to get out of the UK on holiday this summer, it's already looking a bit unlikely. I can tell you from doing a bit of searching, looking on Airbnb and the like, there's an awful lot of stuff that's already gone and prices have definitely gone up for us. So you have seen that change in behaviour. But broadly, is it going to be a good year for the travel industry? No, it's going to be a tough year in aggregate, particularly for the airlines. But some areas still can do extremely well. And Airbnb booking holdings, they've taken an awful lot of cost out over the last 6 months or so. They've survived what felt like it might have been a near-death experience. And they're probably going to come out this crisis an awful lot stronger than they went in, with a lot less flabbiness, quite frankly.
Yes, I agree with that. I mean, in a case of the companies that can survive, come through stronger and pick up market share from the ones the weaker ones. I think, actually, fun enough, we did have a question on that around why it seems that it's only the number one or two in any in any sector that make money. Ross, I don't know if you wanted to comment on that briefly. I
mean, I think broadly that's probably true. It is the case that there's a lot of oligopolies that have developed and duopolies. There's a few books worth reading on this, but you can particularly see it in the States. There's lots of kind of regional monopolies that have happened. But the bigger reason why that's more the case now than possibly 10 or even 20 years ago is just the growth of online stuff. We've had quite a few questions come through on tech. And I think one of the problems is technologies. It's not really a helpful phrase. It can cover anything from Amadeus, which does back end for the travel agency and airlines, to Amazon, which is online shopping, to Microsoft, which is all your stuff in the cloud and your Excel in your Word. There's not really much in common with these companies, other than that tech is one of the ways they effectively initiate their business now. But anybody who runs any business now will tell you, it doesn't matter what industry you're in, it's got to have technology in it to run. Otherwise, it is completely going to suffer. So yeah, it is a winner takes all kind of mentality. And I think a lot of that is around the fact that, at least on the consumer side of things, so much stuff is done via your smartphone that I used to say we're lazy until a client didn't like me describing humans as lazy. So I'll change it. We're creatures of habit. So if we've got used to, and even pre-pandemic this is relevant, if we've got used to buying most stuff on Amazon, and Amazon has all our details there, and you subscribe to Prime, which means it's going to come within the next 24 hours, no questions asked. If there's a problem, you get your money back. That actually is a really positive thing from our point of view. It makes your life a lot easier. And we don't need an awful lot of choice. We've said, if you've got 3 travel apps on your phone, Booking being one, Expedia being another, hotels.com, which is owned by Expedia anyway, if you get a reasonable service from them and they're round about the cheapest cost, your incremental demand for another travel app is basically zero. Mm-hmm. And that's really what's happened, is barriers to entry have been created in all manner of different industries through network effects and us being creatures of habit. And that isn't really going to go away. The caveat, of course, is that we've got lots of examples over history of what we call the economic moat, the bit around a business that stops everybody else destroying it, disappearing. We don't have to go far back to 1999 to remember Nokia. Nokia used to make mobile phones, briefly, or not briefly, for some time had about 40% global share in phones, and they don't even make them now, less than 20 years later. So we have a healthy paranoia around the stocks that we look at, that is their business impregnable, and in particular management healthily paranoid that their own economic moat is under threat. But yeah, I don't think that trend is going to change probably for some time, that you need to be number 1, 2 or 3 in a sector to make money, because none of those things we talked about are likely to change anytime soon.
Yeah, it certainly feels that way, doesn't it? I mean, what about regulation, Russell? Do you think that's going to have any impact, or is that going to be sort of more at the margin?
Yeah, I mean, it's definitely here. I mean, I guess it's a shame we don't have the chart in front of us. There was a great chart showing the amount of regulation according to sectors. And the tech industry as a whole has very little regulation. That's just the fact. And it's partly because nobody knew what a social network was 20 years ago. So you couldn't really legislate for it or regulate for it. Regulation's coming. It's definitely going to be here. Have tech companies, just to take them as one example, got involved in bad behavior? Yes, they have. Like most companies, they've been at the edge a little bit. Does it mean that their business models are completely destroyed if there's a level of regulation? No, it doesn't. Quite frankly, if Facebook, which isn't a stock that we particularly recommend, but if it was forced to break up by the regulator into WhatsApp, Facebook, Instagram, it probably would be worth an awful lot more, quite frankly. The biggest regulatory breakups you've had in the world, in the States, were Standard Oil over 100 years ago, and AT&T 40 or 50 years ago. I can't remember, probably 40 years now. Both of those, if you just held on to the stocks that they were broken into, you would have made a very large sum of money. So I don't think it's anything to fear. And I think it's probably a good thing, really. You can't have one area of the market that's not really regulated properly.
Agreed. Yeah, agreed. I'm conscious we've got quite a few questions on technology, but so I'm not. But I don't want to sort of direct all the questions to you, Russell. So, Jeremy, one that's come in for you is just around investing within fixed income. Obviously, yields are extremely low at the moment. They look like they're going to remain low for a very long time. Against that backdrop, where would you allocate money at the moment?
Thanks, John. Yeah, that's always a tough one now when we know that clients see gilt yields for 10 years paying you 0.3%, and up to 5 years, and even further out than that, you will get a negative return on holding gilts to maturity. Last year, that question became was a lot easier for us. Yields were higher. We saw a great opportunity in credit around the time of March, because fiscal policy meant that costs were being controlled and helped by the government, even though revenues sharply declined because of lockdown activity, while companies raised debt in anticipation to keep liquidity high to ensure that they could survive through the pandemic. And at that market stress level, we saw some great opportunities to invest in credit. That has, since any crisis, the quickest erosion of amount of credit compensation, where you demanded 1% at the start of 2020, It went up to 4% above respective government bonds for investment grade, and that's now back to 1% above government bonds. So credit, while we had a very firm recommendation, we've tempered that down in terms of our recommendation on it, really stressing selectivity in parts, where we see some bank debt being quite a potentially attractive proposition. Rationale for that is banks were forced to cut and omit their dividends and preserve capital as central banks rush to provide these banks with liquidity. So we saw banks actually being holding quite firm, and also looking at more diversified banks which had investment banking activity saw some bumper years with the amount of issuance and M&A and more corporate activity there. So now the way we look at it, we take a bit more nuanced approach, looking at getting diversification through a mixture of government bonds, more globally diversified, looking a bit at select inflation-linked bonds. The reason they're US inflation-linked bonds, which we really liked, have risen quite sharply following the Georgia runoff, which meant the Democrats have secured a very thinnest of majorities there, which could see fiscal policy tick up in the US, i.e. leading to more supply of treasuries and potentially higher inflation, as well as higher government bond yields, as well as more nimble in terms of how we play that, with a bit more owning maybe European inflation-linked bonds, and also holding a little bit of shorter dated credit, where we see some value in shorter dated sort of high yield pockets, amongst others. So I think the key message here is remaining nimble, not too wedded on one view or another, and be active, allocate throughout it. And that's what we always seek to do. We always rethink the allocation, and when we think valuations have moved too far, then we temper our views and look to get involved in areas where we think we see better value.
Yeah, great. John, can I add something on that from a multi-asset point of view? Is that in the past, one relied on fixed income for income, and in many cases you just held to maturity. Now you get more income from your equity than you do from your fixed income. And Jeremy mentioned being much more nimble. I think in terms of equity, we try and buy and hold for the compounding effect that Russell mentioned. And perhaps in terms of an asset allocation, one needs to be slightly more active and more nimble, as Jeremy says, in fixed income than one would have been in the past, where one just held to maturity. So I think there's a change of attitude. Is instead of trying to trade equity, one trades more in bonds than perhaps in equity markets. So it's a change of philosophy, perhaps over the last 5 years or so.
Yeah, no, I think that's absolutely right, Jonathan. Agreed. And to that extent, we've sort of certainly been researching and adding more sort of strategic bond funds to our our approved lists, and looking to put those into client portfolios, because those managers have the ability to sort of trade around a lot more actively in what is a slightly less liquid space than equities traditionally as well. Very conscious of time. We've sort of reached the end of our sort of allotted time for questions. So thank you very much, Jonathan, Jeremy and Russell. And thank you very much, everybody, for joining in. As mentioned, if you had any questions that we didn't get around to answering, we will please do raise those with your LGT Vestra contact, and we will endeavour to address those as promptly as possible. And yeah, thank you again for joining us today. Hope you all found it interesting, and wishing you all a very good afternoon. Thank you.
Thanks very much. Stay safe.